is Eva. I'm an accountant and an enrolled agent, and today I'm going to talk about how to pay yourself no matter if you're a sole proprietor, an LLC, or an S corporation. If you've ever wondered how to do this correctly, or you've been hit with a big tax bill and you don't understand it, then you're in the right place. By the end of this video, you'll know exactly what method is the best for you. So let's kind of talk about what it is to pay yourself. So as a business owner, how you get paid depends on the structure of your business. You're not the same as an employee, even if you work within your business. So what I'm going to call salary throughout the rest of this video is the amount of money you would pay someone else to do your job. So that is the money you earn by performing services. I'm also going to refer to something called an owner distribution. This is the distribution of the profit. So profit is the reward you get for going out on a limb and starting a business. This has nothing to do with what you provide to keep the company going. This is your incentive for opening this business and taking the risk. Your salary is what you get paid for the services you perform for the business. And how you get paid depends on what kind of entity you are. A sole proprietor does not pay themselves the same way an S Corp owner would. So let's talk about the different kind of business structures to begin with. So if you're a sole proprietor, that means I just went on to irs.gov, I got an EIN number, I'm opening up shop, it's just me. So when you're a sole proprietor, that goes onto a Schedule C on your personal tax return. So what is an LLC? A lot of people get confused when it comes to LLC because it's kind of like a buzzword. I want a company, I'm going to open an LLC. And people don't really understand what comes with it or what it means. So LLC means limited liability company. And the purpose of it is to shield you from liability. So when you're a sole proprietor, you are one and the same with your business. So if anything goes wrong in the business, then it goes wrong in your personal life, So if someone was to sue you, then they come directly after your personal assets. So people establish an LLC to limit the liability that can come onto them personally. So that's the purpose of an LLC. So when you file to be an LLC, it's to limit you from liability. It has nothing to do with how you file your tax return. So if you're the only person in your LLC, a single member LLC, it's a disregarded entity and you're treated the same as if you were a sole proprietorship. It also goes on your personal return on a Schedule C. So then we have an S corporation. So for an S corporation, oftentimes how it happens is you have a person who opened up a company and they registered to be a limited liability company. Then they go to the IRS and tell the IRS, I want to be taxed as an S corporation. So an S corp is an election you make. It's a pass-through entity. So there's no tax on the S corp level. So when you decide to be an S corporation, you're now filing a separate tax return. So you file a tax return for the business, and then you get a K-1 from the business for your profits, you get a W-2 from the business for your wages, and that comes through onto your personal return. This is another way, kind of a covert way to separate your business from your personal, because now you have a different tax return. So even though it's still a pass-through entity, let's say you were to get sued. If somebody sues you, now it's harder for them to figure out all the moving parts that you have going on, because now they have to know to ask for your business tax return versus just asking for your personal and everything about the business being on your personal return. So I'm getting a little bit into the weeds, sorry. We'll get more into depth about the different kind of business structures in further videos, but that's a good base for you to understand how to pay yourself. When you are a sole proprietor, you are subject to something called self-employment tax. So that is essentially the FICA. So the Medicare, Social Security that you would pay at your job, you don't pay it because you don't have a job. So you pay that on your tax return. So when you work a traditional W-2 job, you pay half of FICA, the employer pays half of FICA. When you are a self-employed individual, you are responsible for both halves of FICA because you are both the employee and the employer. That combination equals self-employment tax. So that is a tax that you pay in your tax return that is separate from income tax. In a Schedule C, you are prohibited from paying yourself through a W-2. That is the distinction between a Schedule C and a S Corp. In a Schedule C, you are not allowed to pay yourself. An S Corp, you are required to pay yourself. So when you're a Schedule C, the net income, which is revenue minus expenses equals the net income or profit, that is the amount that is considered your wage as a business owner. And that number is subject to self-employment tax. So how you pay yourself is essentially through distributions, which we mentioned before, is you pull out the money that is the profit. So you're able to do whatever you want with that profit when you're a Schedule C, but you are going to pay self-employment tax on that full number, okay? So when you elect to be an S corporation, you are required to pay yourself through a W-2, and you are required to pay what is called a reasonable salary. So a reasonable salary is a very fluid kind of number, but we want to stay in compliance. We want to stay in compliance with the IRS, but pay you as little as possible. But let me tell you what that means. So a reasonable salary is what you would pay for someone else to perform the job you perform in your company. So if you're a doctor, let's say you're a doctor and you open up a doctor's office. You cannot open a doctor's office and say, I'm going to make my salary $15,000. You are automatically in conflict with the regulations of an S Corp because you could not pay a doctor $15,000. And that is a form of tax evasion. We don't want to evade tax. We want to avoid tax. So we want to have a reasonable salary, nothing more. So for a doctor, depending on the profit of the practice, should be somewhere $100,000 or more, depending on how well the practice does. We're not going to say $300,000 just because we can, because we want to avoid tax, but we're not going to make it $15,000 because we don't want to evade tax. Anyway, so in an S Corp, you pay yourself through a W-2. And then the profits, like we mentioned before, you can pull out the profits as distribution. So let me tell you the difference in how you're taxed because of this. So when you're a Schedule C, remember, all the net income is taxed as self-employment tax. When you are an S corporation, you pay yourself through a W-2, and you are, once again, you're both the employer and the employee. So as the employee, you have your FICA taxes withheld from your W-2. And then on the employer side, you pay the employer's portion. So you're still paying essentially self-employment tax because you're paying the employee FICA and the employer FICA. But here's where it gets good. You only pay that FICA on your salary. So all of that profit that you make, that you pull out personally, avoids FICA, which entails you avoiding self-employment tax. Let's say in a business, you make $100,000 and you decide that my pay in that is $50,000. On a Schedule C, you'll be charged self-employment tax on the full $100,000. In a S Corp, your wages of $50,000 will come through and you'll charge essentially self-employment tax on $50,000, but that $50,000 of profit avoids self-employment tax. This has nothing to do with income tax, but simply by being an S Corp, you avoid a payroll tax. That is the purpose of a S Corp, is to avoid payroll tax, at least on your profit. Savings can be significant, but it comes with administrative costs. So when you're an S Corp, like I mentioned before, you have a separate tax return now. So now you have to pay to prepare your personal and your business tax return. And then there are specific requirements to maintain your S Corp status. I'll go over those details in later videos, but there is admin costs that come with an S Corp to where it's not all just tax savings. There's other things that come with it, but at a certain income level, it is definitely worth it. I usually like to say once you start to get to 100,000 or more of net income, that's when we start entertaining the idea of, hey, maybe we should do an S corporation. If you want more feedback about that for your specific business, you can click the link in my bio to schedule a free consultation, and we can talk through what it would look like in your scenario. To wrap it up and go back to our original question, sole proprietors, single member LLCs are one and the same. Those go on a Schedule C, you do not pay yourself a wage, you pull your money out through your profits. A S corporation, you're required to pay a salary. You pay yourself through a W-2. We did not talk about C corporations, but I'll mention it here quickly. So a C Corp is like a regular corporation so someone like McDonald's, you would pay corporate tax on the business level. So you get a salary from your business and you get dividends from that C corporation. We don't really deal with C Corps and small businesses, but I may go more in depth in later videos. And then also you have partnerships. So that could be like you and your friend decide to open up a company. So you're a partnership. Partnership is also considered self-employment. So you are not allowed to pay yourself through a W-2. You can pay what's called guaranteed payments or through distributions. And we'll talk about that in later videos, but partnerships are also subject to self-employment tax. So the three different times, whether it's self-employment tax or not, is Schedule C, sole proprietors, partnerships all pay self-employment tax. S Corps do not. So S Corps, you get paid through W-2. Schedule C's, you get paid through just pulling the money out as a distribution. And to clarify how to pay yourself, then give me a like, subscribe to the channel, and in the comments, tell me how you currently pay yourself and if this video helped enlighten you a little bit of how you should do it moving forward. Also, I have a little quick toolkit in the description if you want to click through there to get a little bit more information to guide you through your decision, or if you want to book a one-on-one session with me, that'll be down below as well. Thank you for tuning in. I'll see you next time.